The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Just doing a quick sound check. We sound good? All right. We will begin at 8 o'clock, so about 3 minutes. Hi there. Welcome to Weekly Option Trading, the Option Pit method. This should be a great introduction to weekly options and some methods for trading them. Should be a lot of fun. For those of you that don't know me, my name is Mark Sebastian. I am the founder of Option Pit. I was a floor trader on the Amex and on the CBOE for about a decade. I run Option Pit. What we do is work with individuals such as yourself, and we teach you how to trade like a professional. If every individual should have a professional approach to trading, and that's really our philosophy. In addition to that, I also do run a couple of hedge funds, so I consider myself a trader that teaches, not an educator. So I think that's a big differentiation. I am actively involved in the markets, and thus I'm better at helping those who are actively involved in the markets. If you have questions, please save them till the end, or unless they're extremely important. Here's what we're going to discuss today. All right, it should take me about 35-40 minutes. Then we'll go out and do some hunting for some interesting trade ideas. So today, what do traders need? Why weekly options fill that need? How weekly options work? Ways to take advantages of them? Best trades for weeklies, and we'll play with a trade or two if we have time. I am going to close down sharply at 10 Eastern. What do traders want? What do you want from me? I don't want your life. You know, what do you as a trader want? And there are kind of three main things that option traders, I think, want. To start, they want flexibility. Right? Flexibility is really important. The number one thing that I really miss about being a market maker is the ability to just kind of do whatever I needed to do. In, out, trade. The more flexibility a trader has, the more they have the ability to actually express what they're trying to do. Flexibility is the key to, I think, developing the right trade. Right? When traders don't have the ability to exercise flexibility and malleability to what's going on, they lose. All right. What do traders want? They want control. All right. Control is really important. All right. What they want the ability to pick where, when, and how they do what they do. That's really important. All right. I want the ability to control my ins, my outs, my time, my duration. Right? Duration is a very important thing. Right? Do I want to trade in front of earnings, around earnings, before earnings, into earnings? Do I want to trade an event? If so, how? And finally, they want speed. Traders crave speed, and not just on execution. Traders crave speed on getting in, getting out, getting their money quickly. The longer you're in the market, the more susceptible you are to getting beat. Speed matters. So if I can create a trade that will make money quickly, I am at risk for a much shorter period of time. Yes, Ricky Bobby is my boy. And he wanted speed. He wanted to go fast. And that's what traders want. They want in and out. Right? The longer you're in, the more you're at risk. The shorter you're in, the less you're at risk. All right? So let's talk about this. When I was a market maker, I had 6 expirations, and that was it. All right? I had the front month. I had the next month. Maybe I had the third month out. Maybe. Then I would have a combination of 3 other contract months and then 2 leaps. Or 2 other contract months and 2 leaps. That was it. I had about 6 expirations. Think about that. All right. I didn't have a lot of control. All right. I had some, but not like we have now. I didn't really have a lot of flexibility on when I was trading. If earnings were coming, there was 1 month they were coming for. That was it. And speed, well, you only have as much speed as the calendar said. If the front month had a week to go, you had a week to go to expiration. If it had a month, you had a month. There was nothing quick. But now you have that in the weeklies. Weeklies are the answer to control, flexibility, and speed. That is why they're so amazing. Those 3 concepts. This is Apple options as of Friday, March 2nd. Notice between now and July, 11 expirations. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. All right. In the S&P options, there can be as many as 5 expirations in a week. In March, there are 14 expirations this month in the SPX. In S&P options, there is an expiration almost every other day or more. Right? How many trading days were there in March? How many actual trading days are there in March? You know, if I pull up my calendar, Think about this. This is amazing. This is the power that you guys have. All right, there are 2, 5, let's see, 7, 12, 17. There are 22 days in March that are actual, the market is open. Excuse me, 21. We're closed on the 30th. 21 days where the market is actually open. We have expirations on 14 of them. That is power. That is flexibility. That's the ability to kind of place what you want to do. Right? We had a really ugly day today. Today is Monday the 19th. The S&P was down 40. If I was looking to take advantage of a move in the S&P, when I was a floor trader, I would have had to buy the regular March that expires. I would have had to buy the regular April that expires on April 20th if I wanted to do anything. Now, as a trader, I can buy options that expire on today. Options expire today. I can buy the 21st. I can buy the 23rd. I can buy the 26th, the 28th, and the 29th. On Friday, there were 2 expirations, one in the morning, one in the afternoon. That is power. All right, so why are weeklies great? To start, weeklies give you the ability to have complete control and flexibility in your trade. You can trade before, during, and after earnings, an event, an FDA announcement, economic activity, a Fed meeting. We have a Fed meeting on Wednesday. If I want to play the Fed, I can literally buy SPX options that expire 2 hours after the Fed is done talking. That is power. The other thing you get is speed. You get that decay, either for you or against you. So the things to remember about decay. Decay is exponential at the money. Right? That means it gets faster and faster into decay at the money. However, the further away from at the money you get, the more linear decay is. So at the money options are just dying at faster and faster speeds. Somewhat out of the money options are a little more linear. And then you have these cheap options that can take forever to decay. They may never decay until after expiration. This is kind of what that looks like. And then I want to show you on SPX what I mean. All right. So let me pull up SPX options here. Or SPY. SPY is fine. All right, so these are SPY options. They expire on Wednesday, on the 19th. Or no, they expire today, on the 19th. And what I want to point out, we had a weird rally after the bell. I should just use the cash. I'll use the cash. So let's take a look at Wednesday options in SPX. These are the 21st. And I want to show you something. Take a look at this. We settled 27.12. The 22.25s, these expire in 2 days. And these are 500 points out of the money. So 20% down. And there still is a bid. These cheapy options hold value for the longest time. They never, I mean, it's honestly, you're waiting forever for them to die. You know, you go to April. And, you know, April is a month away. There's a bid for the 1,300 puts in April. The 1,300s. A 50% drop. That is volatility. Crazy volatility. Traded around a few things today. So that's the thing to remember. So because of that exponential decay, weeklies can be the best for put selling strategies, covered call writing, the wheel that I will talk about, and I'm going to touch on a couple of advanced income strategies. So let's talk about the triple income wheel, or wheel, as I like to call it. In the wheel, the trader is using three sources to produce income. Source one is puts. And you can do this in an equity or in an index. First rotation of the wheel starts selling puts. You sell at the money puts in weeklies. You follow the secrets of put selling. Now, if you're saying, what are the secrets of put selling? One, there's no secrets of put selling. All right. But I did go through them in, if you go on YouTube, I've got a webinar called Riding the Wheel. And I walk through what I call my secrets. So the key is you want to keep selling that put over and over and over again to build yield. And hopefully you sell all the way down. Lower and lower and lower and lower strike prices. All right. And then hopefully the stock gets put to the trader at or near the bottom. The next source, if you're trading individual equities, is the dividend. Once you get the stock, hopefully you get the dividend. All right. If you're a younger trader, put it on a drip. Acquire more shares. Older traders and employees of an actual company should collect income from the dividend and invest in the overall market. In fact, if you're an older employee, do you think it makes sense if you have work for a company, how much stock do you think it makes sense to own in the company you work for? All right. I like selling the first strike out of the money, Charles. His question is, do you always sell at the money? I like selling the first strike out of the money in puts. If I'm selling further out of the money, I usually do not use that front weekly. I'll move further back because of the way decay moves. Right. So my question was, if you work for a company, how much stock should you own? The answer is as little as possible. Right? You're going to be if you work for a public company, you're going to get gifted options, things like that. Take them, obviously. When they become due, if you can sell them, sell them. Don't get stuck being a WorldCom or an Enron person, right? And a lot of people don't know what happened with Enron. What happened with Enron? Well, they know the long story, or they know the short story about Enron blowing up, but they don't know how much of wealth in Enron the employees had, or in WorldCom. Yeah, there were a bunch of millionaires that were then broke. So the key is own as little of your company stock as you can. Now, finally, in addition to collecting the dividend, start selling calls. All right, calls should be sold at a higher strike than the trader was put to. All right, if you're put to a stock, and remember, that's a net price, right? Remember all of the put premium you collected. All right. Now, if it's really in the money, let's say that you're worried about a big bounce back. Anybody know what you can do with a covered call if there's a big bounce back? And I'll walk through. I'll show you. Yes, some of you are. So let's look at something that I don't have a position in. Here's Google. So let's say I own 100 shares. Put it in the sim here. All right. So you can see there's my delta, 100 delta. So what I can do, let's say I'm underwater on my Google shares. What I can do, I can sell, let's say the 1110 calls. And then if the stock roars back, I can buy like the 1150s for $1. Oh, I want one of these, not 10. Sorry. So what I can do is sell a credit spread. So I'm collecting $9, $9.50 instead of $10.40. But I want to show you on the risk chart. So you get the stock back above the strike price. So that's a little tip here, folks. Yeah, you can sell a call spread instead of a call. But and here's a example from a while ago I did for the street. But it's such a good example of how to play Oracle over a month that I like using it, because this is one I actually followed through on the street. So in September, this was like September 2014, maybe 2015. I sell the September 26.39 put at 22 cents, get the stock put to me. I sell the OCT3 call at 13. I sell the October 10th 39.5 call at 13. I collect a dividend. I sell the OCT39 call at a quarter. I sell the October 24 39 call at a quarter, and the stock gets called away. So I'm in the stock for about a month, and I collected $1.09. It's a 30% premium in a month, annualized. It's a really simple way of doing it. So, nice little trade. All right, any questions on the wheel? All right. All right, there are traders that like to use weeklies for more advanced strategies. I personally use them for calendar spreads and butterflies. And I want to talk about butterfly. Calendars in the S&P have been great the last couple of years. But I'm going to talk about butterflies. So, briefly, do I sell options when vols are low? Yes. I may not be net long volatility or net short volatility, but I will sell vol. Do you asset the put or roll it down? I will take delivery on the put if I'm trading a wheel strategy. All right, so do I take delivery on the put or do I roll it down? I generally take delivery if I'm running a wheel strategy. All right, so what is an iron butterfly? It's simply a straddle that is hedged. It involves the selling of an at-the-money call spread and at-the-money put spread and creates a tightly defined high-yield area for spreads. How many people do weekly condor strategies? I'm going to explain to you why you don't want to. All right, so the iron butterfly is pretty simple, right? See, I'm short a straddle, this is SPX, and I'm long the wings, and you can see where my P&L is. All right, the long out of the money put will typically have a higher delta than the long out of the money call. That's caused by skew. It gives it a short delta. And because the shorts are closer to the money than the longs, that means it's net collecting premium, and so you're long theta. The spread wants the underlying to stay in a tight range and not move. Thus, the spread is very short gamma, and the spread is selling premium. When you sell premium, you're selling vega. You are short vega. Pretty simple. So, let's talk about the characteristics of a butterfly. It's short delta, short gamma, short vega, long theta. What is the key to success? All right. What is the key to success? The answer is IV and HV. So let's talk about analyzing that butterfly. So I want to look for the best fit for my ideas. I'm looking at term structure and IV. So take a look at this. This is term structure in Apple from March 2nd. You can see obviously expiring vol is really high. March 9 is cheaper than the 16th, which is a little cheaper than the 23rd, but things are pretty flat. Movement, this white line is movement, it is dying. The red line is implied volatility, which is just starting to die. This is what I look for. I'm looking for dying movement and starting to die implied volatility. All right, I'm also going to check out term structure to see where I want to sell. Butterflies are the best way to harvest premium out of a weekly trade without taking a directional opinion. The crazy thing is how short of a period is necessary to take advantage of a butterfly. Pigs get slaughtered, smart little piggies go to the market and can buy roast beef. All right, and butterflies are the quintessential get in and get out. You know, my dad, I'm not the biggest guy in the world. All right, so my father actually was a Green Beret in the Army, and he's much bigger than I am. My mom is a short little Italian lady. Unfortunately, I got her height, so I'm just I'm a hair below 5'9". All right, and so at one point in time, I was getting picked on, and my dad pulled me aside and gave me some advice about getting in a fight. You know what his advice was? When I'm getting picked on, if someone way bigger than me is trying to beat me up, All right, here's what my dad said. All right, if you really are scared that you're going to get hurt and you feel like you're in danger, yeah, punch him in the crotch and run away as fast as you can. That was his advice. Thankfully, I never had to use it. But yeah, that's what he told me. It was good advice, actually. And that was his point. If you're really scared that you're going to get hurt. Thankfully, that never happened. I always could talk my way out of them. All right, so let's look at a butterfly. This is an apple butterfly. This is obviously an old chart, but I want to show this. All right. So Apple's trading around 127. I want to look at a split strike butterfly. So what we're doing is I'm selling here and I'm selling here. And I'm buying here and I'm buying here. And I'm actually putting in, selling, hitting the bid and lifting the, kind of using mid prices. And, you get about $1.84 out of the 127, 128 strangle that you sell. Strap, whatever. And the wings cost you about 61 cents. So the net credit on that is $1.23. This is on a Monday, in a weekly. So then here we are on Tuesday, and I want you to notice something. Here, Tuesday, right here. My thorax, the middle, right? It's a butterfly, right? The butterfly has wings. What are wings attached to? In a real butterfly, it's called a thorax. Some of my lowbrow traders call it the meat. I like the thorax better. The next day, my thorax is $1.50 and my wings are 45 cents. So in a day, it went from 123 to 105. What's that for a return if you make 18 cents in a day? Remember, 18 cents, and I was risking on a 2-point vertical. What's 2 minus 123? Yeah, I did 23% in a day. And commissions are so cheap that you just get in and out. Doesn't matter. Take your money. So yeah, the margin, a 10 lot was $770. You made $180 in one day. That's 23%. If you did that every day in a year, you'd make 45 grand on 770 of risk. Now, you're not going to do that, right? You're going to lose some of these. But you're going to win a lot more than you lose. And you'll make your money. Get in, get out. Vol is dying, sell it. Vol died, buy it back. It's that simple. Right? Think about this as kicking a dying horse versus kicking a dead horse. All right, when it comes to trading, you should beat the crud out of a dying horse and then cover when the horse is dead. In this case, the horse died in a day. And then I want to show you what happens. All right, now it's not that easy. Every trader works, but vol risk premium is overpriced, and there's edge in the trade if you get in and out. No, the split strike means you had a directional bias. TJ, no, it was trading 127.5 at the time. One hit, run like hell. Just like my dad told me fighting a big dude, right? One hit and run. Same thing with butterflies. In, out, run. Because I want to show you what happened the next day. So 2 days later, how's my trade look? Well, Apple runs. Take a look. 1, 2, 3, 4. My trade is, instead of being $1.05, it's $1.40. So instead of making 180, I'm giving away 170. Now, two points here. One, because it's a fly, you actually made more than you can make more than you can lose if you do it right. If you're watching vol and you're using smart approaches. But by sticking around longer, by tying up your capital for more days, you'll lose money. The longer your capital is at risk, the more likely you are to lose. If I can hammer that 1 point home, I'll consider myself a success. All right, so when picking a butterfly in a weekly trade, the key is to think about the next 2 days. That is it. What is going to happen over 2 days? I don't care what you use, candles, Bollingers, whatever. You have a 2-day outlook, right? You want the underlying to stop moving for 2 days, which will allow volatility to sink and time to pass. If that happens, you get out. You sell Monday morning, you buy Tuesday afternoon. 2 days. That is it. If you wait longer than that, you're probably not going to win. If 2 days pass and you haven't made money, you are in the wrong trade. All right, so I'm going to look at some trades here in a second. So weeklies provide everything you want. You can learn how to use the wheel. There are great trades in weekly options like butterflies, and there's a lot more weeklies can do. So let me walk through what we're doing, and then I'll look at a couple trades if you guys want. All right, April 7th, we are doing our Mastering Weekly Options course. It is going to be over 4 hours of weekly option trading. All right, Andrew, my chief option strategist, is going to do a bunch of really cool stuff on how to set up some intro trades. Then I'm going to do a couple hours on advanced trades, and then Keith, who I also traded with and I taught how to trade at Group 1, is going to do some weekly stuff on directional trading. So you're going to get stuff on the weekly wheel, you're going to get flies, condors, butterflies, calendars, and some really cool directional strategies. Now, if you go to our store right now, you can buy the weekly option course that we did 2 years ago for $297. And that is what it's going to cost after April 7th. Today, it is $147. $147. And now here's the extra little treat. It is free for members, Trevor. 2 things. If you are an Option Pit Live subscriber, it's free. That's $97 a month. Second, if you use code 25_off, that's 25_OFF. OFF, all capitals. All capitals. It'll take $25 off, so it's just $122. It's a steal. And we're going to be starting at 9:30 and we'll go till at least 1:30 p.m. Eastern Time. You go to optionpit.com/weeklies to sign up. This is going to be a great class. The last one was a huge success. This one's going to be a home run too. All right, the 25 underscore off offer is good until Friday. After that, it'll be 147 again. Still a good price, but not 122 bucks. So the question is, can you use 1x3x2, regular fly, or broken wing with weeklies? Yes. We'll probably discuss 1x3x2s, broken wings in fact, we will, in the course, discuss how to use 1x3x2s and broken wing flies in detail. What is Option Pit Live? That is access to our chat room. We have a daily chat room where we post trading ideas. It will be recorded, Nancy. Where I come on, or Andrew, or Keith, or both of us, or three of us, and I will talk for an hour looking at the market, and I'll come up with some good ideas. Today, my best idea was, I had two really good ideas and two that were not great. But my two really good ideas made a lot more than my two that were not great. I suggested buying the weekly, the VIX call spread expiring today for 23 cents. All right, in the morning. All right, I was long that call spread in the fund, and I sold it out at a maximum price of $1 in a day. It's every day. You can go on our website. That costs 125 bucks. And so if you go to our website, not what I wanted. Right here. You get amazing stuff. 125 a month. Every day. So it's about the same cost as the course. And you get a month of access to me. And Andrew. And Keith. And then I'm on throughout the day chatting with people, talking with people, describing what I'm seeing. It's a pretty nice course. It's a really nice educational and trade idea generation portal. And we've got some educational content that's included. And you get the Saturday classes free included. And we will have a checklist, yes. All right, so who's got a stock they want me to look at? Go to optionpit.com/weeklies to sign up. All right, we're limiting the class to 50 people only. We've already sold, I believe, 25. Ooh, I like Twitter. All right, let's look at Twitter. So take a look. The market is dying and Twitter is not. Look at that range. Twitter's had a really tight range. It actually looks like a really interesting butterfly candidate. So the straddle is going to net you about $1.40. And the strangle is going to cost you about 27 cents. So this is a $1.13, $1.12 butterfly on a 2-point fly. That's pretty cheap, and I like that. Or excuse me, that's pretty good from a price perspective. I like collecting that. That's a nice trade. That actually might really work. All right. That's one I think I like. So let's look at Walmart. Somebody wanted to look at Walmart. We'll do a couple more. Walmart got kind of slammed today. All right. Now I'm going to use weeklies in a little different way with Walmart. Let me look at the vol here. Premiums aren't expensive. It's right up against the 200-day. U.S. Steel. I'll look at U.S. Steel. We'll do U.S. Steel next. We'll do like 4 of these. All right, and what I want you to notice is look at this term structure. It's expensive, and it gets cheaper and cheaper out to about April 6th. So this is one, and we'll discuss a lot more about how I would set this trade up. I'm going to throw out 2 ideas. I would look at this as a potential pullback trade. You get a surprisingly decent amount of premium for the 90s. So I would look at this as 46 cents for the March 23, April 6, 90 call calendar. It was there, almost there yesterday, Friday. 46 cents. All right, now you're picking up 116 deltas. With the vol where it is, I might hedge off a little bit of the delta while the market is tanking and buy like an 87 put. That's what that would look like. So if the bottom falls out, I'm in much better shape. Take a look. Well, let's just do 20%. 20% pop and vol, and I'm not losing money down another $2. But if we rally back to 90, I'm in good shape. So I like that one a lot. All right, let's look at Intel. There's another one with a pretty tight range. Let's look at the vol here. I'm going to show you, here's a trade that I'm not going to, so that is some premium, and that thing is running, and it's right near an all-time high. So I'll tell you what I like about that one. I'd go to April. Instead of using a weekly, I would use a regular April month. Premiums are still pretty cheap given the movement. I'd buy the Strangle for $2 and call it 70 cents. And look at that curvature. I'd sell the 46 calls, and I'd sell the 55 calls. So I'm selling a I would actually do the opposite of what you're used to seeing. I would do a $4 wide butterfly, and I'd pay around $2 for it. But I'd own the meat instead of short the meat. All right, one more idea. Ex-US Steel. US Steel, I actually think is a wheel candidate. With everything going on with the tariffs and everything they're doing, opening up factories, yeah, they're torching it. Meanwhile, business is good for them. This is a great wheel candidate. I'd be looking at the March 23s. Traded 39.06. I'd sell the 38.5s. All right, and you're saying I don't want the margin? Great. Buy the 34.5s, and you've got a 70-cent credit spread. And I would offer it out at 70 and make the market come to me. That would be my trade in US Steel. So again, I want to remind everybody, go and get this weekly course. It's going to be great. You won't regret it. Any other questions? I'm done looking at trades. Any other questions? Would 2 days and then get out apply when buying plain options too? Maybe. You can I buy it for 17? No. Oh, yes, you can, Nancy. Sorry, yes. Any preference for day of the week? No. Yes, Nancy, that's a different story. Yes. Yes, we do have great mentorship programs. We are the best at mentoring because our guys are actively involved in trading. They're trading all day. So you're working with guys that are still in the market that are trading it up all day. Gold comes with 4 months of OptionPit Live, includes the next 4 of our Saturday courses, and comes with a modular class that allows you that really teaches you a bunch of stuff about how to really trade, gives you all the tools you need, and comes with an hour of mentoring and 2 hours a week of live mentoring with me and Andrew. Platinum comes with 15 hours of live individual training. What would an hour cost with Andrew alone? Andrew for 1 hour bills at $425 an hour. I bill at $600. So the gold, you get an hour of Andrew or an hour of me for about the cost of that. Again, what's the minimum monthly subscribe? Yeah, I mean, you can go on our OptionPit Live for $125 and you'll get the weekly course coming. Just go to our optionpit.com and click on the memberships. So gold and platinum, if you have questions about that, they're great and you'll be very happy. How many people are in your chat room daily? It varies between, usually around 50. But I'm there most of the time. Are there any advantages to trading SPX over SPY? There are, primarily tax, but also, you get a better bang for your buck. Yeah, the gold membership and the platinum membership are top notch, and you really cannot go wrong with them. They include all of this coursework, and if you do gold or platinum, gold actually you can pick 4 of our previous courses and watch those. Platinum, you get access to our entire previous library of Saturday classes. Plus, you get to chat with other great traders. That's right. All right, if you have questions about gold or platinum, feel free to shoot me an email. I'd love to set up a time to chat with you. But go out and, if you're otherwise, go and get this course. All right. Thank you. All right, everybody. Have a great night.